And now I have the pleasure of introducing one of our top supporting strategic partners, which is Robert Hall and Associates, who happens to have locations nationwide. Robert Hall specializes in working with real estate agents and their clients, especially in complex real estate transactions where there could be a hefty tax consequences. So please do have them come out to speak at your networks or at your associations. They're actually one of our association affiliates too. And definitely reach out to them personally. And I will be putting in the chat box the business development contact information. So today, our featured speaker from Robert Hall is Tony Watson, who's an enrolled agent like myself. An enrolled agent is certified by the Internal Revenue Service as a tax specialist. Tony focuses on providing personalized financial guidance and tax preparation services to individuals and businesses. As a federally licensed tax practitioner, Tony helps his clients make sound financial decisions and works to ensure all eligible deductions are received when preparing taxes. Should a client need assistance with audits, collections, or appeals, Tony is empowered by the U.S. Department of Treasurer to represent taxpayers before all administrative levels of the Internal Revenue Service. In addition to his one-on-one client work, Tony Watson is the keynote speaker for Robert Hall and Associates. He has spoken for hundreds of trade organizations throughout the state of California. His dedication to his clients and expertise in the field of taxation led him to win the Glendale Reader Choice Award for Best Taxpayer in 2016. And Tony not only works in the real estate industry, but he also works with small businesses, entrepreneur startups, entertainment, healthcare, law enforcement, firefighters, education. So if you have clients in those industries, call Tony. If you're targeting those specific industries and want to hold home buyer and seller financial education webinars, call Tony. So today, he's going to share with us how to use our tax deductions before we lose them, since the countdown for tax year in planning has begun. He will go over why it is important to know your tax situation before the end of the year, the top 5 write-offs, and why you have to make estimated tax payments, why 401ks and IRAs versus my favorite, which are self-directed IRAs and solo 401ks. And he will go over understanding the Inflation Reduction Act and the looming proposed changes. So with no further ado, Mr. Tony Watson.
Thank you. Thank you so much for having me back. It's always wonderful coming to speak for the Women's Council of Realtors. Always a pleasure to be here. Once again, my name is Tony Watson. I'm here on behalf of Robert Hall and Associates. Very honored, very privileged to be able to speak on behalf of my firm. I've been with Robert Hall for going on 2 decades, and we've seen a lot in the tax industry over the last 2 decades. And well, a lot of that change actually happened over the past 2.5 years. So we've got a new, the Inflation Reduction Act on the horizon. It's been signed into place. It will be changed and altered probably 30, 40 times over the next 2.5, 3 years. So we'll be bringing you the most up-to-date information as soon as that starts to roll out. Let me go ahead and share my screen here. The topic today just kind of hits home for a number of reasons as we approach the end of the 4th quarter of 2022. The name kind of explains itself, right? You either use it or you lose it. So we have about 1.5 months left in the calendar year to put a plan in place to position ourselves in the best way possible to help retain the wealth that we've built for ourselves over the past, almost 365 days. The year-end planning season for tax advisors is probably equally as busy and as important as tax season is. Tax season obviously it happens between January 15th and April 15th of the following year. But year-end planning to me is probably even more important than tax season itself, because I want to sit down with my clients. I want to wind down the year, figure out what their year-to-date income, year-to-date expenses are looking like, and figure out what that bottom net income amount is that we really have to pay our obligation and tax on. And as long as we go into tax season knowing all of that information, there should be no surprises come filing season. And in my industry, we do not like surprises. We don't like being surprised when we sit down for the appointment in the 2023 tax year to file for 2022. What all of you might consider to be the most important thing about our relationship or your relationship with your tax advisor, what you might consider to be the most important thing is tax saving side of things. I want you to think a little differently as we move forward into the calendar year end, as well as 2023's filing season. I don't want you to use the term tax savings. I want you to use the term or the phrase wealth retention. they're one and the same. It's the same thing, right? But if you think of tax planning as a meeting or a time that you speak with your tax advisor to implement strategies to retain wealth, I personally think wealth retention sounds a lot sexier personally than tax savings, right? So if you train yourself to think that, sure, I use a tax advisor to help me save on tax. More importantly, I use a tax advisor and a tax preparer, the tax professional, to help retain wealth. I think that you'd be a lot more excited to speak with your tax advisor prior to the end of the year. Like I mentioned, I'm going on 2 decades with my firm here in the Southern California area. I am the keynote speaker for our firm, speaking at over 140 plus events per year. In my individual clientele column or roster, I service about 1,200 tax filings per year personally. And I'd say my clients are well over the $500 million range in managed real estate and other business dealings. So I see a lot at Robert Hall and Associates. Our firm sees a lot as a whole. I by no means am a one-man operation. We have a wonderful senior accounting staff I work alongside. We're about 54 strong, 54 employees strong at Robert Hall and Associates, and we do service tax filings in all 50 states. Our firm is well into the $1 billion marker of real estate operations, management, and wholesaling. We see 1031 exchanges, cost segregation elections, 481A adjustments, and I mean, you name it, we've seen it. With over 10,000 tax filings per year nationwide, there probably isn't a scenario that we haven't run into. And we've been open since 1971. Bob Hall had a dream back in early 1970s about having Robert Hall and Associates as a one-stop shop for all of your financial needs. So we offer anything from tax preparation services to incorporating services, payroll services, bookkeeping. Like I mentioned, we're kind of like a one-stop shop for all of your financial needs. Let's talk about why year-end planning might be important to you or to your clients. I normally, in my consultations towards the end of the year, especially and specifically with new clients, I ask what they consider to be the most important thing about planning before the end of the year. The number one answer is to avoid unnecessary penalties and interest. Of course, we don't want to overpay Uncle Sam. We want to pay our obligation in tax and not a penny more than that obligated amount. So we're going to talk a little bit about what is required of us as taxpayers to prepay before the end of the calendar year to avoid any unnecessary penalties and interest, because that seems to be the number one reason why people put time aside towards the end of the year to put a plan in place for filing season in 2023. Number two would be for positioning, greater positioning power. What can I spend or reinvest my business revenue on prior to December 31st to help retain most of the wealth that I've built for myself? That's a pretty common answer for this question. And last but not least, it's peace of mind. I think this is probably one of the more important reasons why we do year-end planning. It's just to have peace of mind going into the new year. Obviously, around December 31st, we're all celebrating the new year, ringing in 2023. And the last thing on our minds is taxes and the planning for our business. But people, as we enter into that kind of celebratory time of the year and we welcome in 2023, we want peace of mind to know that our money is being put to work for us in certain ways. And at the same time, as it's generating more wealth for us, that we are also paying as little tax as possible on that generated revenue in the most efficient and effective ways possible. I love the phrase failing to plan is ultimately planning to fail, because I think it goes hand in hand with what we as tax advisors do for our clients on a year-to-year basis. If you fail to plan with us, you're ultimately planning to fail. That's why you have to set aside some time prior to the end of the year to sit down with us, either on the phone or in person, and map out a plan prior to the end of the year and wind down 2022's revenue and expenses, and just make sure that you're able to retain as much of that hard-earned income as possible. That's the most important thing. During these consultations, we provide a number of tools for our clients. One main tool that we provide in these appointments is something called a W-4 review. The W-4 review is to estimate what your bottom line liability is well before the year end is even here. In fact, just this morning, I've had 3 appointments already today where we have looked at their year-to-date profit and loss statements, figured out what their gross commission income is that has come in and what their year-to-date expenses have been. And so we figure out a snapshot in time of what their net profit looks like as of today, November 16th. And then we talk about some additional expenses that they could incur for their business between now and December 31st to come up with a more accurate bottom line, extending that profit and loss statement through December 31st. And what power position we take in this instance is we know what we're up against when we file the return in 2023. So let's say we come up with a bottom line profit of $100,000. Let's say you had a great year. You're looking at about 100 grand in net profit. We have unique tools here at our office at Robert Hall and Associates. One tool is called Tax Tools, and it is a program that has a number of calculators that we have access to. And we plug in that 100 grand net profit, and we can print out 3 different scenarios of what you could potentially do prior to the end of the year to help reduce whatever that projected bottom line is, if 100 grand was your net profit and nothing else was spent prior to the end of the year. Then we could throw in a scenario of deferred compensation or retirement plan contribution deductions. Let's say you wanted to go out and upgrade a vehicle for your business, and we wanted to take bonus depreciation on the vehicle purchase. We can throw in a number of scenarios to show you the return on investment from making these moves prior to December 31st. That is a very powerful position for you to take prior to the end of the year, especially if the ROI in a year where your revenue is skyrocketing. Just my first appointment today, she doubled her revenue as a realtor here in the Los Angeles area between 2021 and 2022. She doubled her revenue in the first 8 months of the year, and that's compared to a full year of revenue in 2021. And so we were talking about different things that she could reinvest her money into prior to the end of the year to help keep as much of that money as possible. And she had already been looking into purchasing a new asset for her business, purchasing another rental property. And so we went through some of those scenarios, and I printed out a 3 scenario plan for her. And she ended up maximizing every position that we put in place, or she's going to over the next couple of weeks. And that ended up having an ROI just overall from those tax shelters and those plans that we are putting in place. It ended up having an ROI of close to 48%. That means that every dollar she was reinvesting back into her business was returning her 48% or 48 cents on the dollar in tax savings. And she's essentially just reinvesting profit back into her business. So that's the power of year-end planning and a W-4 review. Now, what does the federal government require us to prepay before the end of the year to avoid penalties and interest? The federal government would love for us to overpay them and then for them to have the control of issuing the refund, right? So they put in place a pretty simple calculation. You are required to pay or prepay either 90% of your current year liability or 110% of your previous year's liability. Now, let's say that last year you had $10,000 of liability that was owed to the government. So if you're going off last year's numbers and you take 110% of $10,000, the federal government wanted you to prepay $11,000 over a 4-quarter period of 2022. Well, let's say that 2022's revenue was double what your revenue was in 2021. So you've had a great year over year from 2021. Well, the federal government says, okay, well, because your revenue increased, you are actually no longer allowed to use the 110% calculation. You have a much higher liability this year. So we want you to prepay 90% of the current year's liability. And that's where this year-end planning consultation comes into play. You won't know what that bottom line net liability is unless you sit down with your tax advisor and map out that plan. If you do not cover the 110 or 90% figure prior to the end of the calendar year, or actually the end of the 4th quarter, which is January 15th of 2023, then you will be subject to penalties and interest. So we need to sit down with our clients prior to the end of the 4th quarter and map out these numbers for the clients. Let's say that you're interested in buying more real estate, you need more cash liquid for yourself. Some people will choose to skip estimated tax payments, knowing full well that they're going to incur penalties and interest. But by keeping that cash in their bank account, they figure that the ROI on some other unique investments, the ROI would be greater than the 2.5 to, let's say, 3% penalty and interest they'd pay simply by keeping their money. So we need to map out these plans with our clients prior to the end of the year, and just to make sure that you're in the right financial position entering into 2023. So keep that in mind. W-4 reviews are very common in the tax industry, and that's what we do mostly at the tail end of the year. October 17th was the deadline to file for 2021. So we're well past the 2021 tax year. We're on to planning for 2022 and what 2022 has to bring tax-wise for our clients. Now, what are some of the top tax deductions coming out of the pandemic years? Because let's face it, the past 2.5, 3 years have been crazy years for a number of reasons. I'm going to tell you that deductions, expenses, spending for business owners has changed drastically over the past 2.5 to 3 years, especially and specifically because some people weren't able to go to their office and work. They were forced to work from home. They weren't allowed to go door knocking, or even if they did door knock, people weren't opening the doors because they were afraid of this nasty COVID thing. I'm actually sitting at home right now because my wife and my daughter have COVID and I can't go into the office. So this thing is still alive and doing very well. It's kind of a crazy time for us to all be alive. But I'll tell you from a tax perspective, these top tax deductions, they have changed over the past 3 years. Number one deduction I saw really people maximizing to the fullest during the pandemic years was marketing and advertising. I saw some self-employed clients of mine quadruple their spending power in marketing and advertising, redeveloping their websites, sending out mailers, creating new business cards, new merchant branding items. I mean, anything that they could possibly do to get their company's name out there to the general public. Whether it be in person, as we started to open back up, the economy started to open back up, or even during the years of 2020 and 2021, when we were all still pretty much shut down, just still trying to connect with clients and broaden their overall clientele servicing areas. So we saw a number of clients really invest a lot of time, a lot of money into merchant branding and marketing and advertising their business. Great dollar for dollar tax write-offs for the self-employed business owners in today's webinar. Number two, another skyrocketing expense during the pandemic, professional supplies and equipment. Just personally speaking, when we were shut down during the pandemic and I was forced to work from home, I had to upgrade my laptop. I had to upgrade my monitors. I basically wanted my office in Glendale to be set up in my in-home office in Eagle Rock, which is where I live. So I had to upgrade all of my equipment. I had to increase my internet speed. I had to download software programs to make sure that I was protected from malware and whatnot. So, professional supplies and equipment has always been a consistent write-off for business owners, but I feel like it has absolutely either doubled or even tripled for some business owners coming out of the pandemic. A number of reasons why I like professional supplies and equipment is one, it is the most consistent write-off for a business owner. I mean, think about this. How many people do you know who do what they do professionally or can do what they do professionally without a computer, without a cell phone, without a desk, without a chair, without a calculator? These are the most common deductions for business owners. And so therefore they have some of the lowest risks for audit. In fact, in 19 years, going on 2 decades that I've worked in the tax industry, I've yet to see an audit on a computer purchase. I've yet to see an audit on a cell phone purchase or a desk or a chair or a filing cabinet purchase. So I like this for a number of reasons. One, it has a very low risk for audit. It's one of the more consistent write-offs. And two, we have options of how to write these expenses off. Let's say you've already reinvested all of your profit back into your business. And at the moment, you're already showing no profit on the tax return. So you're not paying any income tax. Why would you take that $3,000 computer dollar for dollar as an adjustment when you don't need it in this year? So this is not the case where if you don't use it, you lose it. This is actually an option that you have. You can take that piece of equipment and either take it fully as a write-off in this year, but if you don't need it this year, you can actually spread the deduction out over the depreciable lifespan of the asset. Equipment, for instance, like a computer or a mouse or a cell phone, has a 7-year lifespan. Furniture, office furniture, has a 5-year lifespan. So you can either take it fully all in 1 year by accelerating the write-off. It's called Section 179 of the Internal Revenue Code that allows you to do that. Or you can take this deduction over the next 5 or 7 years, depending on what type of asset it is. Now, let's say 2 or 3 years down the line, your revenue starts to bump back up. You have less expenses. You can then take the remaining deduction over the next 4 or 5 years, still remaining and carrying forward, and you can accelerate it in a year where you actually need the deduction. So once again, I like it because it has a low risk for audit, and we have options of how to write this expense off. Professional supplies and equipment, absolutely maximize those angles on your return. They're great dollar for dollar adjustments to your federal taxable income. Number three, I'm sure that we are all very aware of what's been happening in the automotive industry over the past 3 years. Because of supply chain issues and chip shortages in the automotive industry, we have seen prices for vehicles skyrocket since the beginning of the pandemic. They're starting to kind of return to somewhat of a normal level of price action. But at the end of the day, we're still seeing the car in my driveway, I could probably sell it for an extra 5-10 grand on top of what I originally paid for it still, because it is a car that people are looking to purchase for business use. So during the pandemic, I always joke with my clients, I always tell them I should be getting commission checks from Tesla because of how many Tesla Model X's I've sold for Tesla. And I'm a tax advisor. But in 2018, under the 2018 tax reform bill, the federal government brought back something called 100% bonus depreciation for heavyweight vehicles that are used for business use. So we're talking about the Chevy Tahoes, the GMC Sierras, the Tesla Model X's, the G-Wagons, the Range Rovers, these heavyweight assets that weigh over 6,000 pounds. That's the key weight class that they need to be in. If the vehicle has a gross weight of over 6,000 pounds, it qualifies for something called 100% bonus depreciation, making that vehicle dollar for dollar tax deductible on your federal tax return. So imagine this, you come in for your year-end planning appointment, you had already been looking to purchase a new vehicle. Let's say that you want that brand new Chevy Tahoe, you need to throw the kids in the back seats, you want to take the family on family vacations, or you need to throw all of your real estate professional signs in the back, but you don't want a truck bed, you want an enclosed SUV. So you're looking at this brand new Chevy Tahoe, let's say it's about 70, 80 grand of income. You come in for the tax appointment already knowing that you're going to make this purchase eventually over the next month or 2 months. And you come in and you say, Tony, I have $100,000 of net profit I need to wipe out. Well, okay. In this case, if you're going to buy an $80,000 SUV that weighs over 6,000 pounds prior to the end of 2022's calendar year, that means that you get to take that 100 grand in net profit and reduce it dollar for dollar by $80,000. And so now no longer are you paying tax on 100 grand, you're paying tax on $20,000. Now, in certain income brackets, let's say that you're in the 30% federal bracket, effective tax rate bracket, and let's say you're in the 9% state income bracket, so 39% total. Essentially, that $80,000 deduction in this scenario would save you 39% in tax savings. So 39 cents on the dollar on an $80,000 write-off. I'm being very vague with the calculations, obviously, but you kind of get the gist of what I'm trying to say. These are massive adjustments to your overall taxable income, but it's all about date placed in service for these vehicles. You can't put a down payment on a new Tesla Model X that is set to be delivered in 2023. The keys have to be in your hand prior to December 31st of 2022 in order for you to take that write-off. It's called the date placed in service rule. So make sure that you understand some of these rules before going out and putting deposits down on these heavyweight vehicles. Now, if you purchase a vehicle that's under 6,000 pounds, don't worry, you still get a write-off for it, but it is not at 100% acceleration of the bonus depreciation. It is max $18,200 in first year write-off, and then the remaining value of the vehicle is depreciated over 5 years. I don't expect you to learn all of this right now or grasp all of this in just a short amount of time that we have here, but I want to whet your palate, so to speak. I want you to take these questions to your tax advisors, or if you don't have a tax advisor, come and talk with us at Robert Hall & Associates and discuss some of your options, because these are great dollar for dollar ways to reduce your overall taxable income prior to the end of the year. And guess what? You don't have to buy it outright cash. You could put $5,000 down on a Chevy Tahoe with a purchase price of 80 grand, finance $75,000 on it. And guess what? You still get the $80,000 dollar for dollar adjustment to your overall taxable income. Secondly, it doesn't have to be a new vehicle. It could literally be a used 2018 Chevy Tahoe that you're purchasing. So it's new to you, but it's not new as far as make and model is concerned, but it is new to your business. And let's say you're getting this used 2018 Chevy Tahoe for $50,000. That is a $50,000 adjustment dollar for dollar to offset self-employed income. So just understand that these are some of the great options that you as self-employed real estate professionals have and that you can take position-wise prior to the end of the year. We're seeing a lot of people do this prior to the end of the year because, and this is really key here, under the Inflation Reduction Act, which we'll get to in a couple slides, the Inflation Reduction Act drops the bonus depreciation benefit from 100% down to 80% as of January 1st of 2023. So this is the last year that you'll be able to take 100% of the accelerated depreciation as a write-off. And I'm not saying that 80% isn't a good amount for a deduction, but you do lose 20% of that deduction if you purchase the vehicle in 2023 as opposed to 2022. So just be aware of that adjustment in the new year. If you're not looking to purchase a new vehicle or acquire a new asset like this, you're probably looking to take the mileage write-off over actual auto expenses. Mileage is about 55 to 56 cents per business mile as a write-off. So that's a very common deduction for self-employed individuals and business owners to take. Just make sure that you're maximizing the angles on the auto and truck expense side for your business. Number 4, remember, we're talking about the top 5 tax deductions here. Number 4, legal and professional fees. In 2018, under the Reform Act, we had thought originally when they just came out with like the preliminary code in 2017 for 2018, we had heard that legal and professional fees were no longer tax deductible. So the money that you pay your tax advisor, for instance, wouldn't be a tax write-off. We thought that that was going to be a change all the way back in 2017 and 2018. When the final tax reform bill was passed in 2018, we realized that legal and professional fees were no longer deductible for W-2 employees, but for self-employed individuals and real estate investors, legal and professional fees were absolutely still write-offs, because you were putting them on certain forms with your individual return that allowed for a dollar-for-dollar deduction benefit. So also make sure that you're working with a tax advisor who knows about some of these things that were potentially changes in 2018 and under the Inflation Reduction Act, and what actually became final code, because this was a big concern to a lot of taxpayers in 2017 and 2018. Just like we're seeing a lot of concern under the Inflation Reduction Act with a lot of the changes that did pass and a lot of the changes that were squashed at the 23rd hour, which once again, we'll get to in a couple slides here. Last but not least, probably one of the most important things, and probably a piece of advice that you can share with a lot of your clients, is bonus depreciation, not on the vehicle side of things, but bonus depreciation on real estate investments, large capital assets. I can't tell you how surprised I was that during the pandemic, more and more people started, I think it was because they were sitting at home educating themselves. You know, after they put the kids down for bed, or if they weren't able to go and sit at a Starbucks coffee and have a conversation, they were sitting at their computer, and maybe these free educational webinars were popping up and kind of right in their faces. So a lot of people were educating themselves about unique tax shelters for real estate investors. Cost segregation, for instance, has been around for quite some time, but over my 2-decade career at Robert Hall & Associates, I'd say that prior to the pandemic, I saw equally as many cost segregation elections as I saw in the 2.5 years of the pandemic. I mean, literally, I must have done 50 or 60 cost seg elections in 2020 and 2021 and in 2022. And that was probably in total what I had done prior to the pandemic in my whole career. Now, cost segregation, for those of you who don't understand what cost seg is, it is an election on a real estate investment property to accelerate future year depreciation. Now, why would you want to do this, right? Let's say that you've got a client who is purchasing real estate as part of their real estate portfolio. They're buying properties outright cash, or they have great cash flowing investments already as part of their portfolio, and they're always looking for additional tax write-offs. So they keep acquiring property, hoping that additional mortgage interest and property taxes and insurance and depreciation might help reduce some of this cash flow and save them some tax. Well, there's only so much that you can do with real estate, right? I mean, you're not going to go out. Not everybody has the opportunity to go out and buy $5 million in real estate whenever they want, right? So sometimes people feel capped out as far as investing is concerned. They just don't have enough cash reserves to go out and continue purchasing property year over year. So what is a really unique part of the Internal Revenue Code is something called the 481A adjustment. Once again, I don't expect you to remember all the terms here, but a 481A adjustment is through a cost segregation election, which allows us to reach forward into future years, meaning years where the deductions haven't even been taken yet, and accelerate and take future year deductions to take it all in this calendar year. So as you can imagine, just the other day, I had a client email me his cost segregation analysis form. And through this cost seg election, this client is able to reach forward into future years, capture $171,000 in depreciation that he hasn't even taken yet, to take it fully as a dollar-for-dollar deduction in the year of 2022. He has great cash flowing assets, so he needs the write-off this year. His mortgage debt is very low on the properties. Depreciation is almost fully exhausted because he's owned these properties for well over 25 plus years. So depreciation is coming to an end. With this $171,000 accelerated cost seg depreciation write-off in 2022, it allows him to wipe out all of his income. Basically, he's not paying any tax for this year. And with that tax savings, he's reinvesting into purchasing more real estate investments for himself. So with this new real estate investment that he's going to close on in 2023, he'll do another cost seg election on that property, save all the tax, paid almost nothing in income tax to Uncle Sam and the state of California, because California conforms to this part in the Internal Revenue Code. And with all of these tax saving shelter benefits, he's buying more real estate. This is the number one way that the wealthy are able to capitalize on their assets. And if you are entering into a higher income bracket because your business is really starting to pick up, these are the types of elections that your preparers need to talk with you about. They need to have conversations with you about. These are absolutely some of the greatest ways to shelter income, pay very little in tax, and allow yourself with that tax savings to reinvest into other capital assets. For some of you who have been around for a long time in the real estate industry, you might be thinking, well, Tony, if your client's not paying any tax, how are they able to qualify for loans? Well, for those of you who understand the lending side of the equation, this is a depreciation write-off. The 481A adjustment is depreciation. So a lender will take this depreciation. You might not be paying any tax and showing very little, if no, taxable income, but the lender won't see it that way. The lender will take the depreciation deduction, they'll add it back as income onto the return and qualify this particular client that I was talking about, qualify him based on $180,000, $190,000 of taxable income, even though he's not paying any income tax in the 2022 tax year. So these are just phenomenal tax shelters for, it's like the holy grail of tax shelters for real estate investors. Make sure that you are working with a tax advisor who understands this part of the Internal Revenue Code. All right, so those were the top 5. Now, as far as understanding a little bit more of the Inflation Reduction Act, and we'll talk about some of the new IRS employment figures and what that means for audit ratios and in-home office deductions, things like that. Let's talk about one thing that I'm very, very happy about not changing under the IRA, the Inflation Reduction Act. That is Section 1031 of the Internal Revenue Code. At the 23rd hour, right before President Biden signed the Inflation Reduction Act, they decided to squash any changes on Section 1031. For those of you who don't know what a 1031 exchange is, it's the ability to take a rental investment, whether it be commercial or residential, and exchange it for like-kind investments. Meaning that if I've owned a warehouse for the past 40, 50 years and I inherited it, so my basis is very low from 40, 50 years ago, now it's worth, let's say, $5 million. If I sold it outright while I'm still alive, I'd pay a massive capital gain tax to Uncle Sam and the state of California. Under Section 1031 exchanges allow me to take all of this capital appreciation, all of this capital gain, and exchange it for other like-kind investments to avoid paying the capital gain tax and any recaptured depreciation tax. The Biden administration originally had discussed capping the amount of deferred gain to $500,000 per taxpayer. I thought, this is crazy. Why would they change a part of the Internal Revenue Code that's over 100 years old? Well, at the 23rd hour, thank goodness, I had knocked on wood. I had prayed to the real estate gods that they wouldn't change Section 1031. And at the 23rd hour, they decided to squash it, meaning that Section 1031 still has an unlimited amount of deferred gain that you can cycle into other like-kind investments. It was absolutely a crazy idea to change it in the first place, but thank goodness at the 23rd hour, they did not change it. Just a couple statistics on the exchange industry. 1031 exchange industries globally create, on a global scale, over 600,000 jobs. 600,000, not 60,000, not 6,000, 600,000 jobs for the global economy. It generates over 40 or 50 plus billion dollars in collected revenue for the federal government on an annual basis. And exchanges make up for 65% of all United States real estate transactions. So the 1031 exchange industry is a massive, it's a beast. It's like, once again, another holy grail of tax shelters for US taxpayers. And I didn't understand why they were trying to change. I mean, I understood from a government perspective because they'd be able to tax people on more revenue, but this part of the Internal Revenue Code is over 100 years old. Don't try to fix what's not broken in this case. So at the 23rd hour, they decided not to change it. Thank goodness. Bonus depreciation rules. We talked a little bit about the car bonus depreciation at 100% through the end of this year. It will be dropping to 80% in 2023, 60% in 2024, 40% in 2025. It will fully sunset and basically be non-existent for bonus depreciation by the year 2027. So make sure that you understand what is phasing out in the Inflation Reduction Act through 2027. I forget the name of the solar professional who we watched the little video on, but I'll tell you, the solar industry is booming right now, especially because the Inflation Reduction Act is increasing the solar system credit in 2023. Right now, if you have solar installed in 2022, the max credit you can take is 26% on the full solar system improvement. That credit increases to 30% as of January 1st of 2023. So if you are already thinking about installing a solar system on a primary residence, second home, or even a rental investment, and it hasn't started yet, you might want to reach out to the solar company and say, hey, listen, I don't mind signing the contracts. I don't mind putting the deposit down on this, but I need it installed in 2023 to take that extra 4% bump in the credit. If you have been having this discussion about making a solar improvement on a property, but you haven't signed any contracts, you haven't opened up a conversation with a solar company about this, you might want to do that quickly, not have it installed in 2022, but at least open up the conversation, the comm line with that person or that company before the end of the year. Because what I foresee, and you can discuss this with Power, spelled with a U, about the potential supply chain issues because of the credit increasing in 2023. I am seeing a lot of clients delay the installation on solar systems to 2023 simply to get a 4% bump in the overall solar system credit. Great overall credit. Just make sure that you open up that conversation as soon as possible with Power, the solar company of your choice. Updates on new IRS employment. Obviously, I think that a majority of the U.S. population, the U.S. tax-paying population, I think we've been losing a little bit of sleep over the 87,000 new agents the government went on a hiring spree to bring on board. I want to put some people's minds at ease, though, because let's talk about statistics during the pandemic. And what I consider to be kind of the middle of the pandemic would be not even tail end of 2020, but like maybe the second quarter of 2021. I don't know if that was actually the middle of the pandemic because, like I said, family members right now have COVID in my house. So I think it's alive and doing very well. But let's just assume for the time being that the first and second quarter of 2021 was the middle of the pandemic. IRS employment numbers dropped to their all-time low in the first and second quarter of 2021. Their total employment numbers had dropped to 35,000 full-time employees with the IRS in the first and second quarter of 2021, causing massive delays in processing times, delays in issuance of refunds, delays in issuing checks, the pandemic-related stimulus checks, those kept getting delayed for some people. And so I know on average, the government has anywhere between 80 and 90,000 employees on a year-to-year basis prior to the pandemic. So when the IRS employment dropped to 35,000, roughly 35,000 employees in the middle of the pandemic, they had to go on a hiring spree simply to catch up on the 3 million document backlog they had in the 2021 tax year. They are still playing catch up, by the way. So the wait times on the phone with the IRS are still 2-3 hours sometimes. The processing times for paper filings can still be up to 8 to 12 months. They are playing catch up, but I truly think that the 87,000 people that they hired are to fulfill one of two goals. One, to replenish or put butts back in seats that they lost during the pandemic, number one. And number two, even prior to the pandemic, the IRS had estimated that 65% of IRS employees were going to move into retirement by the year 2026. So they were already planning on hiring a certain amount of agents going into that projected 65% retiring spree in 2026. So just to help you sleep a little bit better at night, this is not something that surprised me at all as a tax advisor. I think that the media outlets really wanted to instill fear in the United States taxpayer by just throwing this 87,000 number around left and right without any consequence. But I truly believe that a majority of those hirees are meant to fill seats that they lost during the pandemic, and also to make sure that when that 65% number does move into retirement in 2026, that they have people in place to continue processing all of the documents, the e-files, the correspondence letters, the issuance of refund checks or collections side of what the IRS does, just to make sure that they don't fall behind again. That 3 million document backlog, we're still dealing with that in the tax industry. It was a nightmare for a number of reasons. I had clients who were depending on the U.S. Postal Service to deliver certain things to the IRS, check payments and copies of tax returns, correspondence. And then we all obviously heard during the pandemic that some people at the U.S. Postal Service were dumping buckets of mail into dumpsters. That was happening right in our own backyard here in Los Angeles. So checks weren't making it. They weren't being cashed. And so the government's trying to figure out, well, how do we assess late penalties and interest if we knew that this was happening? So just a little snippet as we continue talking about some other changes here, is anything that you submit to a state or a federal agency moving forward, send everything certified return receipt from here on forward, because we are still seeing delays simply because things are lost in the U.S. with the U.S. Postal Service. Okay, we will get back to some sort of normality, I guess you could call it, but it will take some time. We've seen some adjustments in the stock market. We've seen some adjustments, obviously, in the real estate market. Obviously, we've seen adjustments in the interest rate side of things on the lending side. A lot of my lender clients think that over the next 6 to 8 months, we will see interest rates start to drop again. I'm hoping they are right on that. But we'll have to wait and see, right? It's a very unique time that we're all living in. And as we approach the end of the year, I think that aside from all of the other things that we have to worry about in life, tax planning, it only takes an hour or 2 hours. It might take some time for you to organize your information at home and make sure that you have all the pieces of the puzzle so that we as tax advisors can put together the puzzle for you. But set aside some time to do some planning prior to the end of the year. Retirement contributions, talking about self-directed IRAs, solo 401ks, traditional and Roth IRA investments, traditional 401k investments. I know that a lot of people aren't really very excited to plug their money into the stock market these days. And so the self-directed IRA and the solo 401k conversations have come up more now than probably ever before, simply because people have been watching the stock market. They're not very happy with the gains or returns or lack of returns that they're getting these days in the US stock investments. Self-directed IRAs and solo 401ks have been around for a very long time. In fact, self-directed IRAs have been around since the early 70s. And unlike a traditional IRA or a traditional 401k, which solely invests in stock investments, a self-directed IRA and solo 401k can invest in the stock market if you want to plug your money into the stock market, but it can also purchase real estate investments, invest in real estate syndications. It could even acquire businesses under the 401k or the self-directed IRA. I had a client in 2020 acquire a salon under her solo 401k, and that salon had shut down during the pandemic. They had applied for EIDL loans, PPP loans. They managed to weather the storm, and now it's a very, very quickly growing salon in the Pasadena area, and it's all held in my client's solo 401k. So all of the cash flow in that solo 401k, all the dividends that are being paid back to the client, it's all tax-free. Because that's the whole benefit of a retirement plan, is that the return on investment that you're getting is all going back into a tax-deferred retirement account. Now, that's on the solo 401k and self-directed IRA side of things. You can have a Roth module, meaning that you pay the tax up front on whatever the earnings are, and then the growth within that account is tax-free moving forward. So I don't have enough time to go through the ins and outs of each retirement account today, but just to whet your palate once again about what options you have out there. And the most important thing is to work with a tax advisory firm that understands a lot of these different tax shelters and kind of the holy grail parts of the Internal Revenue Code. These options have been around for a very long time. Most of the real estate professional tax code has been around since the early 60s. And it's mind-blowing how many people are just learning about some of these benefits, and they've been in the industries, in the real estate industries for 30, 40 plus years. But that's one of the main jobs of a tax advisor, is to make sure that they're up to date with any new shelters that are coming about under the Inflation Reduction Act, or different positioning, different ways that we can position our clients prior to the end of the year to help retain wealth. But also to know about a lot of the tax shelters that have been around for, decades. 30, 40, 50 plus years. Like I said, 1031s have been around for over 100 years. You got to work with a tax advisor who understands all of these parts of the Internal Revenue Code. We'll open up for Q&A. I did want to end on this particular screen. If you are interested in a free consultation with any one of our senior advisors, you can go ahead and text the words Robert Hall to the number 72,000, or open up your smartphone camera, scan the QR code on the bottom right part of your screen, and it automatically prompts you to sign up for that free consultation. Send over 2 years of tax returns to us. Even if you're not wanting to onboard with us, it's a free review of your tax filings. Why not take advantage of the free review? And if you're not looking to have a review of your return, at least sign up for our free webinar division, our free educational webinars taught by me. I'm the only keynote speaker at the moment. I'm trying to onboard some other tax advisors at my firm to do public speaking, but all of our continued education is free at Robert Hall & Associates. And we service, or we provide roughly over 140 events on a year-to-year basis. And they're all free education for people who want to put aside an hour or two of their time to learn about the wonderful world of the tax industry and different types of tax shelters they can take advantage of. So once again, thank you so much for having me. I'm ready to rock and roll with any questions that any of you have.
Thank you, Tony. And I think I see Don, your hand is up.
Hey, Tony, Don McHugh, good to see you. Folks, I've known Robert Hall & Associates for probably over 20 years. I've been in the office many times, enjoyed a lot of Christmas parties, and had you guys out to my estate planning councils and done presentations. You guys are top drawer, not only in your ardent pursuit of every tax law and benefit that's available, but just nice people. So a question for you is on the cost seg conversation. If I understand correctly, it's better to do it on kind of a new building rather than an older building that's already been fully depreciated or almost all depreciated. So it's prudent to make sure that you do that in what, 5-7 years?
That is correct. Yeah, thank you for including that piece of information, Don. So if you have a property that you are that is fully depreciated, cost segregation wouldn't really do much for you because you've already taken that benefit over a 27.5-year lifespan for residential, 39-year for commercial. It works best with new acquisitions 9 out of 10 times. You can do it on properties that you've owned for a couple of years, but when you acquire a property and do cost seg in the same year as acquisition, you don't have to file something called a change of accounting method form. It's called a 3115 form, which has a lot of scrutiny under the Internal Revenue Code. The Internal Revenue Service likes to audit the form 3115 because you're electing to change your accounting method with the IRS to accelerate this massive adjustment to offset income. So yes, it's more commonly seen in years where your clients have acquired real estate investments. We promote that cost segregation in that first year of ownership, just so we don't have to file any change of accounting method. If you've owned the property for 5 or even 10 years, it still might be worth doing the analysis. The analysis in most cases is very cheap to do. We don't do the cost seg. We have a third-party vendor, Jeffrey Gann with GTG Consulting. He used to be out of Pasadena with Incentax. He's a magician at cost segregation, and he'll put together analysis to see what he could potentially accelerate as far as depreciation is concerned. He sends us those figures. We put it into our calculator, see how much tax it's going to save you, and then we move forward from there. But yeah, thank you, Don. It's mostly done with new acquisitions simply because we don't have to file the change of accounting method, but it can be done with older properties, probably not properties that you've owned for 20 plus years though, because you're kind of at the tail end of the depreciable lifespan.
Is there any kind of similar opportunity on residential investment properties?
So residential investment and commercial both qualify for cost segregation on the federal and the state side. So
I didn't know that. Thank you.
Yeah.
Good to see you, Tony.
You too, Don.
Are there any more questions? Unmute yourself if you have any more questions for Tony.
You know, one other seminar, once again, with this free consultation form, like if you don't want to onboard with a new tax advisor, at least let us take a look at your self-employed revenue and see if incorporating might be the right thing for you. I mean, a majority of the webinars I do are around the power of Inc. Because I feel like for all the self-employed individuals in today's webinar, if you have never been told not told, but if you've never had the conversation about whether or not incorporating is right for you, that might be a conversation that could end up saving you tens of thousands of dollars in tax. I can't even tell you how many times I'll get a new client who comes into the office who's got, you know, consistent years of 100, 200, 300 grand in self-employed income. And I do this calculation for them. And I don't like to do the calculation because it's usually like, how could I have not known about this in previous years? How come my current preparer never told me about this? But if you've been self-employed for a certain period of time and your consistency in net revenue is above $100,000, you've been leaving a minimum of about $10,000 of liability on the table on a year-to-year basis. Because at just $100,000 in net revenue, the tax savings by filing as an S corporation versus a sole proprietor is just shy of about $10,000. So let's say that you've been a sole proprietor for 5 years, right? At $10,000 in tax savings per year, not having that advice of filing as an S corporation, you've left $50,000 on the table with the government. There's a lot that you could do with 50 grand. You could put that as a down payment and own real estate by now if you just incorporated 5 years ago. So the numbers have to make sense, but this is also a really powerful PowerPoint and webinar that I give personally, as well as a conversation that you can have with one of our tax advisors through this free consultation. Is incorporating right for you?
Hi. Thanks so much for this. This is Lisa. Can I ask a quick question?
Of course.
So in terms of, I actually just got my first investment property. And so in terms of writing off the depreciation, so say 2022, you know, I don't need to write off as much. Like, so you take a smaller amount for 2022, like you amortize it over 20 years, and you can kind of take a bigger chunk, you know, next year in 2023 if I want versus 2022, just based on my tax kind of liability and where I want to, you know, where I need to have more tax savings and where I don't, depending on, I should say, which years I need to have more tax savings. So you can kind of fluctuate that number your write-off?
So the Internal Revenue Code is very direct with depreciation. The Internal Revenue Code states that when depreciation is allowable, it must be taken. So you don't have the ability to front load just without doing cost segregation, just by filing a return. You don't have the ability to front load depreciation on the building itself. Let's say you bought it June 1st, right? For $1 million. You take whatever the building value is on this residential rental investment, and you start depreciating it over 27.5 years, because that's the residential lifespan of a rental asset. But because you purchased it in June, you're only going to get half the year of the depreciation. Next year, you'll have a full 12 months of whatever that depreciation number is. However, if you purchased the property this year, and let's say you bought it in June, and you're looking at, let's say you've got other non-passive or passive income from, self-employed income or K1 income from a corporation or a partnership, and you have this cash flow, you might want to elect cost segregation on this new property, accelerating what's called Schedule E deductions. This 481A adjustment through cost seg is a Schedule E adjustment. And if that Schedule E adjustment has other Schedule E income to offset or other like-kind income to offset, that massive loss could also, let's say that it's a $150,000 accelerated depreciation write-off. And let's say that you've got a self-employed partnership or an S corporation that has a K1 with $150,000 of income. Guess what? That $150,000 481A adjustment directly offsets the 150 grand of other income. Now you pay no income tax, and a lender won't see it as you making no income. They'll take that 481A adjustment, add it back as income, and see your lendable income at 150 grand, not at zero. Even though you're not paying any tax and not showing any income, a lender won't see it that way. A lender will have to add back that depreciation. So once again, I think that answered your question, but without cost segregation, you can't adjust and accelerate depreciation without making that special election.
So then in what instance can you do the cost segregation?
Well, you can do cost segregation on any asset that basically is under 20 years depreciated, because the federal government allows you to change the accounting method to accelerate any improvements on building property that is under 20 years. So through this cost segregation, in your case, if you bought this property in 2022, it might be worth it for you to sit down and analyze if cost segregation was the right approach for you, because it would accelerate all of that, the bonus depreciation at 100% in this year, both on the federal and the state side. And if it flows through and offsets income in the current year, great. If you don't need it this year, guess what? You take what you need, and then it carries forward and offsets future year revenue. So you don't lose it, you just don't use it.
Right. Okay. Got it. So no, it makes all sense. And then I had capital improvements were pretty extensive. So that should, those capital improvements could offset, but I don't want to waste everyone's time. So I'll reach out to you offline and we can discuss further, or to your team.
You got it. Sounds
Appreciate
good.
it. Thank you.
Not a problem.
Do we have any other questions? I'm checking the chat box and looking for raised hands. You have a question?
I have a question.
Okay.
Yeah, this is Helen. For the cost segregation, does your company do it, or do you hire a third party to do it?
So there's two parties involved. There's us, and we file it on the tax return. We file all of the 3115 forms, the actual election for the 481A adjustment. We do everything on the tax side. The person who does, technically a third-party vendor has to do the analysis, and I think it's a conflict of interest for an accountant to do the cost segregation, just like it's a conflict of interest for a tax accountant to do the appraisal on like a conservation easement investment. So it has to be two separate industries. So we use Jeffrey Gann with GTG Consulting. He comes in, does the full-blown analysis of what he could accelerate as far as 20-year or shorter depreciation lifespan on the property. And then he sends us that number. So like just yesterday, I got an email from him on this one client. They were going to accelerate $171,000 of bonus depreciation. I plugged it into an analysis calculator, and it's going to end up saving the client like close to $85,000 in tax for this year based on his income bracket. So we use a third-party specialist to do the cost seg, and then we file everything, including the election, on the tax filing.
Just your general idea, what would be the average cost for this type of third-party cost segregation study?
The analysis is actually, I think, only like $200 or $300. The initial analysis, the filing itself depends on how many properties are involved in the cost seg, because you can do cost seg on a portfolio of 10 properties if you want, and that would be obviously more costly because it's per property. For one property, depending on what is able to be accelerated, I can use an example here. There's a client of mine out in Temecula who has a massive Airbnb property. It's also got a vineyard on the property. they had put in close to $500,000 in improvements into the property during the pandemic, and it rents out for like 15 grand a weekend. I mean, this is a massive Airbnb. It's a wedding venue.
Wow.
All this stuff. They ended up paying $6 grand for their cost segregation election, and it accelerated just shy of about $400,000 in depreciation as a dollar for dollar adjustment for the 3 business partners. And then the loss ended up flowing through to their individual returns. Each of them file in different brackets, so the tax savings was different for each partner. But that was about $5 or $6 grand for that analysis, and the property value was, I think, 3.5 million. I believe, $3.5 or $4 million, I think it was. And that was $6 grand for the analysis. So I think there's some outside factors. You'd probably have to talk to Jeffrey Gann, because he's a whole other separate entity from Robert Hall and Associates. And he's the one that knows the fees for his company.
Okay. What do you say, Jeffrey Gann?
Jeffrey Gann. Yeah. Jeffrey is spelled a little different, not with a J. It's Geoffrey. So Geoffrey, and Gann, Gan. And he owns GTG Consulting, LLC.
Okay, got it. Thank you.
And we work with him very closely. So when he sends us those figures, we put them into the calculators, figure out if it's worth moving forward. But for the $200 or $300 or whatever the analysis is, it's worth every penny to know, hey, if I can accelerate 100, 200, 300 grand of depreciation, if it's a larger property, I mean, I've seen $1 million accelerated bonus depreciation amounts on college housing out of Texas. I have a client who does college syndications, and he runs 100 investor syndication out of Texas. It's a massive University of Texas college housing building. Their cost segregation election 3 or 4 years ago, I think it ended up accelerating like $2.5 million of bonus depreciation, which then ended up saving quite a bit of money. Now, most of the investors were retirement accounts, so there's no benefit to them, but the individuals who were actual investors, not through their retirement accounts, they received a massive depreciation adjustment and helped offset other income on their personal returns. So we work closely with Jeffrey Gann to make sure that it's the right approach, just to make sure that there's a benefit for you.
Great, thank you.
Okay, any more questions? I see it's 2:12. And I see there's a question regarding the recording available for attendees. Yes, we will be sending out the recording to the attendees, along with Tony's information, which is also here on the screen. Okay, I'm looking.
So Tony, it's been a while. It's been a while, Tony. Is Mr. Hall still around?
Mr. Hall is still around, just not in office. Bob and Janice have moved to Florida, as well as Stephen Hall. So Steve and Bob were both, I mean, Bob's the founder of the company. He's still alive and doing very well. They're living in Florida now.
Good.
And Stephen Hall and his wife and his kids moved to Florida as well. Kathleen Hall, their daughter, lives in Florida as well. Robert Hall Jr. still lives here in California, but he runs massive businesses outside of the tax industry. So I hardly ever get to see any of the Halls anymore. So we're just, we're rocking and rolling under the Robert Hall name still though, but they're all doing very well.
Yeah, good for you, brother. Thank you.
Yeah, thanks.
Okay, Tony. Well, thank you very much. And I guess